This video looks at an intragroup transaction relating to a depreciable non-current asset and preparing consolidated financial statements in the current period. Here, Michael's parents sold the car to Michael's subsidiary in the current period. In this case example, on 1st of July 20XO, Michael raised $520,000 of share capital. After receiving cash that morning, purchased 100% of Samuel's business ownership, amounting to $500,000. And on 1st of July 20XO afternoon, the same day, purchased a 1-year-old car for $20,000. The car dealer sold the car and showed documents that the estimated useful life is 5 years with no residual value at the end of the asset life. Michael used the straight line depreciation method. The investor firm is called Michael Parent and the invested firm is called Michael Subsidiary. On 2nd of July 20XO, that is the following day, Michael Parent sold the car to Michael Subsidiary for $25,000. So that's an intergroup transaction. You have received the financial statements for Michael Parent and Michael Subsidiary for 1st July 20XO and the year ending 30th June 20X1. The income tax rate is 30%. Required for the year ending 30th June 20X1. 1. Prepare consolidation journal entries. 2. Prepare the consolidated financial statements. So on 1st of July 20XO, Michael raised $520,000 of share capital and invested $500,000 in previously Samuel's business, now it is called Michael's Subsidiary, and purchased a motor vehicle. That motor vehicle cost was $25,000 and had accumulated depreciation of $5,000. So the cost of the car was $20,000. So net assets, there are no liabilities. Net assets equal $520,000 and is supported by shareholders' capital of $520,000 in Michael Parent. In Michael's Subsidiary, at the date of purchase, there was share capital of $200,000. There was retained earnings of $290,000. Because it is at the beginning of the year, there are no current period earnings. So the shareholders' capital is $490,000. It is supported by assets, land $466,000, and there was cash $24,000. There were no liabilities, and the net assets are equal $490,000, which is supported by shareholders' capital of $490,000. On 30th June 20X1, at the year end, Michael Parent has sold the motor vehicle to Michael's Subsidiary and received cash. And Michael's Subsidiary has recorded the purchase of the motor vehicle at $24,000. So the remaining useful life of this motor vehicle, because it has been for 5 years, and when it was purchased, 1 year is expired, the remaining useful life is 4 years. So 4 years is the remaining useful life and $24,000 is the purchase price for Michael's subsidiary. Therefore, accumulated depreciation is 6,000 and the depreciation expense for the year is 6,000. So Michael was operating the business, made revenue of 8,000 and cost of sales of 2,000, and the net amount of cash is 6,000, which is shown in the cash account. So the Michael parent shareholders capital is 522,800, supported by net assets of 522,800, and in Michael's subsidiary shareholders capital is 490,000, and it is supported by net assets of 490,000. Michael's subsidiary did not make any profits because there was revenue of 8 and cost of sales of 2, and then there was depreciation expense of 6. Therefore, the total expenses are 8, and that is set off against the revenue of 8,000. Because there are no fair value adjustment in the subsidiary, Michael's subsidiary, we can get to the elimination of investment against the fair value of Michael's subsidiary equity. And in that, we credit investment in subsidiary 500,000, and then at the date of acquisition, the share capital and retained earnings were 200,000 and 290,000. So we debit 200,000 for share capital and retained earnings 290,000. The investment, the excess investment, is for the goodwill on consolidation, which is 10,000. Our second consolidation journal entry is to eliminate unrealized gain on the sale of motor vehicle and to restate the original cost and accumulated depreciation. So on 2nd of July 20XO, Michael had the car and recorded the cost as 25,000 with accumulated depreciation of $5,000. And then Michael sold the asset and then made a gain of $4,000, which is also recorded. Michael parent bought this asset and recorded it as 24,000. At 2nd of July 20XO, because it was just bought, there was no accumulated depreciation to record. So if we look at these entries, to restate the original entry, we must now increase the cost of the motor vehicle by $1,000 because it's now recorded as $24,000. And accumulated depreciation is not recorded at all, and we need to increase accumulated depreciation by $5,000. Gain on sale of motor vehicle, there should not be a gain on sale because it's an intragroup transaction, so we need to decrease that gain by $4,000. So our consolidation journal entry, therefore, is to increase the accumulated depreciation by $5,000 and then increase the cost of the motor vehicle by $1,000 and then decrease the gain on sale of motor vehicle by $4,000. Because gain is a credit account, we need to debit that. Our third journal entry is because the value of the asset for the economic entity is $20,000. That's for the parent. Parent recorded it as $20,000 because the parent sold it for $24,000. The tax base increased to $24,000. So here the tax base is more than the economic entity carrying value by $4,000, and it's an asset. And therefore, that difference is a deductible difference because the tax base is more than the carrying value. Applying the tax rate, the deferred tax asset becomes $1,200. Therefore, our third journal entry is to debit deferred tax asset $1,200 and to credit income tax expense of $1,200. Our fourth consolidation journal entry is to adjust for the depreciation expense. The remaining useful life was 4 years at the end of the transaction. So if you look at the asset value for the economic entity, as if it was not sold and it has been held by the parent, then the carrying value at the time of the sale was $20,000 because it's $25,000 less $5,000 is $20,000. And the useful life, the remaining useful life was 4 years. And therefore the depreciation expense is $5,000. That's $20,000 divided by 4 years. After the sale, when subsidiary recorded it as $24,000, the useful life is 4 years and the depreciation that is recorded is $24,000 divided by 4 years is $6,000. So there is a difference of $1,000 and that depreciation expense must now decrease because it's overstated depreciation expense. Therefore, we credit depreciation expense and we debit accumulated depreciation of the motor vehicle. Now that 1 year has passed, our fifth journal entry is to decrease the deferred tax assets for using the asset during the period. So at the beginning, the carrying value of the asset, if it was not sold, would have been $20,000. But after depreciation, it became $15,000. Our fifth journal entry is to decrease the deferred tax asset during the current period. So if you look at the carrying value of the asset, had the asset not been sold, would have been $20,000. And because of the depreciation, which is $5,000, at the end it should have been $15,000. But for the subsidiary, he bought it for $24,000, so at the beginning it was $24,000. And the depreciation was $6,000, therefore at the end the asset value is $18,000. Because the asset has been sold, the tax base has now increased compared to the carrying value. So at the beginning of the period, the tax base was $24,000 because there was a sale, and the carrying value is 20,000. So tax base is higher than carrying value by 4,000. So that's a deductible difference. Applying the tax rate, it's $1,200. And that $1,200 is what we have recorded previously for the deferred tax asset. At the end of the period, the tax base is now revised to $18,000 and the carrying value has revised to $15,000, and the tax base is still higher than the carrying value and it's an asset, and that difference is $3,000, a deductible difference. Applying the tax rate, it's $900. So from $1,200 it has become $900. Therefore, there is a decrease of deferred tax asset of $300. So we credit deferred tax asset $300 and we debit income tax expense $300. Let's now look at the consolidation worksheet. In our consolidation worksheet, there's Michael parent and Michael subsidiary, and there are notes, and there are debit and credit adjustment columns, and then finally the group column. So our first journal entry is to eliminate investment in subsidiary against the share capital and retaining earnings at the date of acquisition in the Michael subsidiary, and the investment that is more than the fair value of shareholders' equity was 10 million, and that's goodwill on consolidation. So that's our first journal entry. Our second journal entry was to eliminate the gain on sale of investment. In that, we debit the gain $4,000 and we credit accumulated depreciation $5,000 and we debit motor vehicle $1,000. Our third journal entry relates to deferred tax asset arising, and for that we debit deferred tax asset $1,200 and we credit income tax expense $1,200. Our fourth journal entry relates to depreciation expense, that is the excess depreciation expense, to reduce excess depreciation expense. So we credit depreciation expense $1,000 and we debit accumulated depreciation $1,000. And our fifth journal entry is because the asset has been used up, our deferred tax asset has now decreased by $300. So we credit deferred tax asset $300 and we debit income tax expense $300. So once that is done, we can now add across the rows taking care of the accounts, whether they are debit or credit, and also the fact that the adjustment columns, they're debit or credit. We can see our depreciation expense for the year is $5,000 and not $6,000, because if they had that Had there been no transaction, then the depreciation expense should be $5,000. Our accumulated depreciation is for 2 years because there was $5,000 of accumulated depreciation at the time of purchase, and along with this 5,000, it has now become $10,000. Our cost of the motor vehicle is the cost that we have recorded, and that is $25,000. Then if you look at our income tax payable, there was income tax payable because there was a sale of the motor vehicle. Because of the sale of the motor vehicle, there's income tax payable of $1,200. So had that been no adjustment, then we credit income tax payable $1,200. We debit income tax expense $1,200. Because there has been no sale to an outside party, because this is an intra-group transaction, we have to now eliminate the income tax expense, because that income tax expense should not belong there. So it gets deferred, and that deferral is the deferred tax asset. So that's $1,200. Therefore, our income tax expense becomes 0.3. 0.3, that's $300, not $1,200, because for 1 year it is $300. Over 4 years it will become $1,200, but for this year it is only $300. And our goodwill on acquisition is $10,000. Land, there was no change of $466,000, and the deferred tax asset has now decreased from $1,200 into $900 because the asset has been used up for 1 year, because we credited deferred tax asset $300 and we debited income tax expense $300 because the asset has been used for 1 year. The investment in the subsidiary is 0. And if you look at our share capital, is the Mica parent share capital of $520,000, because Mica subsidiary share capital got eliminated in full because the Mica parent acquired 100% interest of the previous Samuel's business, now Mica subsidiary. Our cash position has increased from $24,000 plus $6,000 to $30,000. And our shareholders' capital in the group is $520,700, and net assets equals $520,700. That brings to the end of the video. Thanks for watching.